Everybody, welcome to the call. We really are excited to have you on the call tonight, and you're going to get to ask all the questions that come across your mind or that you knew you wanted to ask an expert and just didn't know when or how you'd get that opportunity. So I want to welcome you to the call tonight, and I want to thank you. But before we introduce our speaker, we want to thank our president, Mike Jacobson, and our executive director, Karen Yap, for allowing these types of trainings and just the information that's being passed along to our members. It is really, really beneficial. And, of course, my name is Wendy Lovejoy. I'm the marketing director for Georgia, and we are really, really excited. We had a great turnout on Monday evening. Everybody had questions for Dyches Boddiford, but tonight you get to ask them. We didn't go through all the questions, so we're going to let him just give a quick recap on who he is, who he helps, and what is the purpose of tonight's call. And then we're going to open up for questions, so have your questions ready. And please, everybody, when you ask your question, feel free to just say your first name if you feel comfortable doing that. Ask your question, and then allow him to give you the answer, okay? So with that being said, we're going to turn the call over to Mr. Dyches Boddiford. Thank you so much for being on the call tonight.
Thank you very much, Wendy. I appreciate the opportunity to talk here and to answer questions that people may have about the presentation I did at the general meeting and about asset protection and estate and legacy planning in general. There really is no off-limits questions tonight, so I would encourage everybody as we go along to jot down questions that you might have and chime in when Wendy asks for questions so that we can get your questions answered. As many of you know, and I assume that there may be a few people on here that weren't at the general meeting on Monday night, but we talked about several different things. First of all, I talked about that I've been around for 34 years in the real estate business. I've only been teaching about 23 years now, but I'm still a full-time real estate investor. And not only do I do a lot of real estate, I have a daughter who is out of Georgia Tech for 3 years now, and she's been building her portfolio. And she's got a closing coming up at the end of this week for another house that she is purchasing to quick turn, and I've been helping her with those projects as well. So I do have a finger on the pulse of the market. If I was a great prognosticator and could tell you everything that was going to come up, then I'd be a billionaire rather than just a few millionaire. But I'll be glad to take a whack at any of the questions you might have about the economy and where we're going with the real estate right now. I will also remind you that Monday night we did talk about a philosophy of wealth where I talked about building income, starting out obviously with work that you're doing for somebody else or maybe for yourself. Flipping properties is work because if you get laid up in the hospital, that stops. But rental properties, mortgages, and so forth can be an excellent way to get automatic income, which replaces that working income. And then, of course, once you get the income coming in automatically, you need to concentrate on building your net worth to a point that you can retire comfortably at some point. Of course, along the way, send your kids to college, do other things that you would like to do. And then, of course, your estate plan needs to be in place, and you don't need to build your wealth to the point of paying enormous estate taxes. The estate tax exemption has been raised, but there's a lot of issues that come along with estate planning in addition to just the tax implications. Then we also talked about basic asset protection and the different kinds of entities, which I'm sure some of you will have questions about tonight. What kind of investments or what kind of businesses should you put in the different kinds of entities? And we can certainly entertain some questions on that. So I think, Wendy, that kind of gives enough of an overview to get everyone started with their questions.
Great. Thank you so much. And with that being said, we're going to ask our Executive Director, Karen Yap, if she'll unmute the call, and then Please take your time in asking your questions. Have the courtesy to let if somebody starts a question before you, let them finish, and we'll get to everybody's question tonight. Okay, guys? Thank you so much.
Okay, don't be shy.
Yes. Okay, please feel free to ask your question. I know I spoke with Della earlier today, and she had a question for Dyches. Are you there, Della, and you ready to ask your question? If not, we'll go with whoever is ready to ask a question. Please feel free to just, if you don't want to state your name, you don't have to, but feel free to ask your question.
Sabinus Smith.
Hi,
hey,
Sabinus.
Do you have a question?
Hello.
Yes, go ahead with your question.
No, I was just joining, and they asked me to announce myself.
Okay. All right. Well, while we're waiting for you to formulate your questions there, let me just tell you that one of the reasons that we're doing this call and I came and spoke Monday night is that myself and an attorney, an estate planning attorney, will be doing a weekend class next week, the 23rd and 24th, here in Atlanta near the airport, on estate and legacy planning. And this will be particularly for real estate investors because a lot of estate planners, a lot of financial planners don't know what to do with real estate. So we're going to talk specifically about how to deal with that real estate. How do you deal with family members that don't understand the real estate and don't know how to run it if you pass on and they're left with inheriting that? So I would encourage you to look at the Georgia REIA website for information of all the things we'll be talking about. We'll be talking about rolling options, powers of attorney, long-term care, gifts and gifts with strings. There are split purchases, estate for years with remainder man, pre-inheritance trust, which is something I really like, and the benefits that come from different kinds of trust. I'm a big believer in trust providing you a lot of benefits that you need, not only from an asset protection and a tax standpoint, but just from a standpoint of making sure that the beneficiaries you want to receive your assets get those assets, and those assets are protected. And we'll even talk about how to disinherit a relative and how to guard against fights among heirs. So I think it's going to be a great class. We had a great attendance last year. There's a lot of sophisticated investors coming in from out of state, so you'll get to network with people in other parts of the country that are doing real estate, and you might just learn some of their tricks that they wouldn't be willing to tell you if you were in their backyard. So now, do we have someone that wants to start off our questioning?
Hello, Dyches. This is Chris Ford.
Yeah, Chris?
Yeah, I actually have two questions. One is I actually wondered what comments would you be able to share tonight regarding power of attorney.
Okay.
And question number two is I was not at the general meeting on Monday, but I had overheard someone say that you had mentioned something regarding investors can make mistakes by owning too many properties once they reach retirement. And
correct. All right, let me address both of those then. First of all, let's talk about the power of attorney. There's basically two general types of power of attorney. One is called a limited power of attorney. And if you ever have gone to a closing where, say, a seller couldn't make it to the closing, but they sent, say, their spouse to the closing to sign for them, they had to have what was called a limited power of attorney. The purpose being that that person signing was given the power from the principal, the person giving the power of attorney, to sign for them for a specific purpose at a specific time and specific date. And that's called a limited power of attorney. If you've ever dealt with banks that wanted a power of attorney, it is often a limited power of attorney to only deal with that account. A general power of attorney is someone that has, for instance, you give someone a general power of attorney, they can do any financial transactions as if they were you. So a general power of attorney is so they can handle bank accounts, they can handle closings, either buying or selling real estate, making mortgages or getting a mortgage. That's a general power of attorney. So you got to be very careful about who you give a general power of attorney to. For the purposes of protecting your estate, if you get laid up in the hospital and can't handle things, what you want is a durable power of attorney. And a durable power of attorney is a power of attorney that's good even when you're incapacitated, whereas a normal power of attorney might end if you get laid up in the hospital and are unresponsive or in a vegetative state. A durable power of attorney will continue operation until you pass. Now, once you die, all powers of attorney are canceled at that point in time. So you want to make sure that you have someone, your spouse, maybe a child that's financially savvy, or someone else that you trust implicitly with a durable power of attorney in case something happens to you. So that's your powers of attorney. A lot more involved than that, but that's a overview of the different kinds of powers of attorney. Now, your other question was about owning too much. Well, one of the issues that most people have is they always want more. And as you build and you get enough to sustain yourself and your family, and you continue to build after that, all you're doing is creating a situation with more headaches and potentially a state tax situation. Estate taxes now have an exemption of $5.34 million per year, or in the year that you pass for 2014, and that increases by an inflation factor each year. Well, if you know real estate as that as your properties get paid down by your tenants over the years, that you can easily end up with $3, $4, $5 million worth of net assets. So the comment I tell real estate investors is determine what you need. Now, the easiest way to do that, and most financial planners will tell you this, you figure out what it takes to live on per year, not exorbitantly to live on, not in a castle or whatever, but comfortably, and not Spartanly, not when you cut everything to the bone, but comfortably. Put in what it takes to go on vacations. Put in what it takes to send your kids to private school if you want to do that. What it takes for your housing that you have per year. And don't forget income taxes, because Uncle Sam always has his hand out every time you make money wanting his share. So figure out how much that budget is for the year. Then take that number and multiply it by 25. Now, since the Great Recession a few years ago, some financial planners will say multiply by 30. But it doesn't matter. You pick. Do you want to be real conservative? Multiply by 30. If you want to be just conservative, then multiply by 25. What that really means is that if you have that amount of investment assets, now I'm not including things like your cars and furniture, and I don't care if you have artwork that's supposedly valuable. Those are not things that you're going to readily sell. So don't include those in your investment net worth. But if you have 25, say, times the amount you need to live on per year, then you can pull out the amount you live on per year 25 times out of that net worth. So 4% of your net worth could be spent on your living each year. Now, yes, I know there's going to be inflation, but there's also going to be some growth in your assets as well. And in real estate, typically it will keep up with inflation and surpass inflation by a few percentage points. So you could live not just the 25 years, but probably 50 or 60 years if you decided to retire early. Now, once you have that amount of assets that you need and you gain more assets, obviously it's going to take more of your time and potentially put you into an estate tax problem. So the best thing, instead of building a big estate to leave to your children, to other people that you want to inherit something from you, then you need to help them build their portfolio. Now, that does two things. Number one, it provides that you can get somebody else to actually do all the heavy lifting. You're providing them the expertise. You may even be lending them the money to help them buy property. And that property is theirs. So you get to see how they handle money, how they are financially, how they are as manager of the property, and you can continue to teach them. So when you do pass and you leave your assets to those people, what you have, they're adding that to assets that you help them build, and with the knowledge that you've given them and helping them build their portfolio, they will properly manage and take care of what you have left them. And Monday night at the general meeting, I asked people, and I'll remind everybody on the call tonight, you probably know someone, a family member or friend, that inherited a significant amount of money or assets, and they blew all that money or assets in sometimes as short as a year's time period, but in many cases over the next 5 years, because they didn't know how to handle significant sums of money or didn't know how to handle those particular assets. They become targets for every scammer and every person that wants to borrow money, and they don't know how to deal with that. So help them build their own portfolios. They will remember you more fondly that you helped them to build than just that you left them a bunch of assets. It also gives you time with those people, particularly if it's your children. It gives you time as they get into adulthood to help them learn how to put away money, how to be conservative in their investments, and to manage property. So that was what I was referring to Monday night. Did that answer your question? All right. Do we have another question?
Do we have a question? If you've muted yourself out, unmute yourself and you can be able to ask your question.
Hi, guys. This is Della.
Okay, we have two questions. We heard Della will take you second because we heard somebody else right before you. That person that said hi, Dyches, go ahead and ask your question. And again,
yes.
Go ahead.
This is Janet, and unfortunately, I wasn't on Monday, but we are new investors. We have not yet done our first deal. And
Janet, can I ask you to speak louder, and everybody else, if you're in a noisy background, mute yourself out?
My question is, I was not there on Monday night. I'm a new investor. Have not yet done my first deal. And I was wondering if it's necessary to have some corporate entity established before we even begin to start investing in real estate.
Janet, excellent question. Let me, I think I understood what you said. You were asking, should you have entities in place before you do your first deals? And I'm going to say something that most attorneys would fuss at me about. And I'm going to say, no, you don't have to have the entities to do your first 1, 2, 3 deals. Now, once you get to your second deal, you should be starting to think about entities, and definitely by the third deal, start putting them into place. But you don't even know if you want to do real estate. You haven't gotten to that point of dealing with tenants or dealing with the properties, dealing with contractors. So I think it's best, unless you have a lot of other assets already, I think it's best to go ahead and take some risk, learn of what you're doing, and experience it, and then you will do better in putting the entities in place and keeping them up. Because entities in place that you don't treat properly they're not worth having. But what you want to think about is, let's say, for instance, you're going to buy rental properties, which all of you should be thinking about doing in order to build long-term income. So rental properties, you want all the tax benefits to come through to you. Typically with a corporation, you're not going to get all those tax benefits personally. So you want to use something like a partnership. But the problem with a partnership is that you have liability that comes through as well. So we have an entity that we've had for 23 years, actually 21 years now in Georgia. March of 1993 was the first time that we could set up LLCs in Georgia, limited liability companies. Limited liability companies gives you the advantage of the tax benefits coming through the LLC to the individual members, but the liability that might occur on a property cannot come through the LLC to the members. So look at doing LLCs for long-term hold properties. Now, let's say you're also doing some flippers, and everybody should know how to do flippers because for instance, when I go through a house, I don't do many flippers anymore, but when I look at buying a house for long-term hold, and I go through the house and determine, no, this is really not the kind of house I want for a long-term hold, then I'll walk through the house again with making it a flipper in mind. If it was going to be a long-term hold, it would go into an LLC. But if it's going to be a flipper property, that is considered earned income under the tax code. And so therefore, instead of having to go to Schedule C of my individual tax return, I want it to go on a corporate return. S corporations for the majority of investors is going to be the right kind of corporation. Use it for any flipper properties and also use it for management of your long-term hold properties because management sometimes has a liability that comes along with it, and let the corporation take that liability away from the owner of the property, which is the LLCs. That kind of answer your question, Janet? Okay. All right, another question. Della, did you have a question?
She sort of asked it. I wanted to know if you were starting right now, what would be some of the techniques that you would employ? And you sort of answered that.
Okay. Well, let me just kind of go into that a little more detail. Some techniques that I would employ, what I see that is working now. Courthouse steps are not working as good now as they did 2 years ago. We bought a lot of property 2 years ago and 3 years ago at the courthouse steps. And most of those were flipper-type properties. We were buying them cheap. We fixed them up very nicely, and we were able to sell them. Today, most of the deals that we're doing come from door knocking, mail-outs, and just referrals. Always let people know what you do. It's good to have a flyer made up to leave with people that say, well, I'm not thinking about selling right now, but maybe next year, give them something that they can keep on their refrigerator or card or whatever so that they call you down the road. So it's one of those relationship building things that it just takes a period of time, and then all of a sudden you'll start getting calls from people that you hadn't talked to for 5 years. So I'd look for mortgages that are low interest rate mortgages that I might be able to take subject to. And don't do subject to deals until you're educated on them, by the way. You got to make sure that you do the titles correctly. Attorneys can help you with that, but you also need to make sure that you know how to do the insurance policies correctly. And unfortunately, most insurance agents don't know how to do that. So make sure that you get educated on that and just how to deal with the mortgage in the long run. Now, if you don't plan on making the payments on that mortgage, if you don't have a tenant, don't do a subject to. Subject tos require a lot of trust by the person that's selling to you that you will take care of the mortgage that has their names on it because you're also affecting their credit reports. I tell people that I buy property subject to from, I tell them that I will be a positive influence on their credit report because we always pay on time. And I build that trust that we do, and you don't. You need to make sure that you adhere to that and don't disappoint them. So that's what I'm suggesting. We still do some quick-turn properties right now. Again, we're finding those quick-turn properties from door knocking. We're also finding some long-term holds door knocking as well. All right?
Thank you.
You're welcome. Another question.
Yes, this is, and I just wanted to know if I have a trust,
and
okay. And then I begin Can an LLC not only own it but be the trustee?
Okay. If you have a trust, and I assume you're talking land trust when you say that, there's all kinds of different trusts, but let's say it's a land trust because a lot of people are familiar with those from being real estate investors. Can you use an LLC as the trustee? In Georgia, which I assume you're in Georgia, most of the people on this call are in Georgia. Georgia does not allow an entity to be a trustee unless that entity is a bank or trust company or otherwise approved by the State Department of Banking and Financing to be a trustee. What they don't want to do is to have a bunch of companies out there, whether they be corporations or LLCs, come in to be trustees of the little old lady's inherited trust that they've got. So it's not that they're doing this against you as having real estate and a land trust. They're really trying to protect people that have testamentary trust or bypass trust that were left by other family members. Now, in some other states like Florida and California, you can have an entity as trustees, but not in Georgia. So it needs to be a natural person. It can be in-state or out-of-state person, can be the trustee of a land trust. All right, another question?
Thank you.
You're welcome. Another question?
Yes, this is Jonathan. I was wondering if you're a new investor and you had, $12,000 liquid, what would you spend that money on?
Well, Jonathan, it all depends on what kind of deals that you can find. And $12,000 is a significant number, don't get me wrong, but it won't go real far in doing the real estate because a lot of renovations require a whole lot more than that. What you might think about is partnering up with somebody else that either has more money or access to money and doing a deal with them. You bring the deal and your money and I still don't use all of it, but use some for the fix-up or some for the down payment, and then go from there. Now, if you are able to find a subject to or able to get owner financing, it could work out real well for you because then you put out a few $1,000s for purchasing the property and then use a few more $1,000s to spiff it up and then start renting it out. Or if it's going to be a flipper property, get that financing, get it fixed up nicely, and resell it and make $10,000 or $20,000 on top of your $10,000 or $12,000 that you're putting into it. But do not go and do only one property with the whole $12,000. You really need to keep what they call keep some dry powder, because you never know what problems are going to come down the road and require some of those funds to solve the problem. One of the things you can do, Jonathan, is think about bird dogging. Go out and find houses that you can get a contract on, even if it takes $15,000 or $20,000 down, or it's going to be an all-cash purchase. And if you made a good deal and have it contingent on approval of your financial partner, then peddle that contract around to some of the wholesalers and see if you can't sell the contract and make, $500 to $5,000 according to how good a deal it is. And that would be a good way to add to what you've got before you start investing for the long term. All right?
Okay, thank you very much.
You're welcome.
I do have one more question about hard money lenders.
Sure.
Are they all, in your opinion, created the same? Do they all basically have the same structure, or do you have to be careful with who you partner up in that space?
You do have to be careful about who you partner up with as hard money lenders, and all hard money lenders are not the same. Their terms are not the same. Their needs are not the same, and what they'll do for you is not the same. So the only thing that is the same between all hard money lenders is they have access to funds, and they're going to use the property, the deal itself, as the collateral for the loan, and they're not going to be too worried about what your credit scores are. but some will look at your credit scores, and they're looking at it a lot of times to just see how well do you pay your bills, and is there a potential bankruptcy there. So don't worry about your credit score, but worry about getting a good deal. Most good hard money lenders that have been out there for years and years and years, and I've been doing hard money lending since the mid-1980s, will go only to 60 or 65% of the value of the property. Now, there are hard money lenders that will go to 75%, and some before the downturn, before the recession, would go to 80 or even 85%. But those guys aren't around anymore because they had to take over a bunch of property and weren't able to get their money back out of it. So you need to talk to different hard money lenders to find out what they will and won't do and what their requirements are. For instance, some hard money lenders will only lend to you for 3 months. Some will go 6 months to a year. Some will go 3 or 4 years. Though I will tell you that because of the higher rates for hard money lending, you don't want to borrow more than 6 months to a year at the most because it eats up a lot of capital. But when you're only borrowing for 3 or 4 months, it's not too bad. It's not a bad expense to incur at all. Then you need to find out how many points they'll charge on their hard money and whether they'll finance those points into the loan or do they want them paid up front. So there's a lot of questions, and as you talk to each hard money lender, you'll find out more questions to ask of the next one that you talk to. Also, you want to, if you're starting out, you want a hard money lender that will actually come out and look at your property and give you some suggestions on it from their experience. Most hard money lenders have significant experience with real estate. Otherwise, they're not going to be in business very long if they don't. But they are looking for you to succeed because they want to loan to you again. So a lot of times you're buying some consulting and some expertise by getting a hard money loan. All right?
Okay, thank you very much.
You're welcome. We have another question.
Yes, this is Janet again, new investor.
Sure, Janet.
I recently ran into a company that is a real estate firm that specializes.
Janet, I'm having a hard time understanding you. There's a company that does something with real estate?
Real estate brokerage company that specializes in all aspects of real estate. The way that it was described is they work with investors and basically will bring them a deal, and if the investor is interested in the deal, they can certainly purchase the property, and somehow their fee is incorporated into the purchase price. My question is, are you familiar with these types of companies, and what are some of the concerns that I should take into consideration if I go to?
All right, Janet. Yeah, Janet, these kinds of they're companies, but there's also individual investors that do this kind of thing from time to time, and they come and go. The first question you've got to ask, and it sounds like you're already asking yourself the question, is what are they going to make out of the deal? What advantage do they have working with you? And one of the problems with some of these is they pull money out of the property when you go into the property. And that means that you have more expense that you have to deal with because they're already paid. Now, if you deal with another investor or a company that says, you know, we'll go into this with you, we'll help you find the hard money that you need, let's say it's a flip, you handle the contractors getting the work done, but we'll give you a list of contractors, and we'll make our profit when the property resells. Now, you can talk to those people because they're working on the back end. They're getting the profit. And many times they do that because they will get more profit on the back end than on the front end. But, Janet, in the long run, you want to work towards doing things yourself or having a trusted partner that you can work with over the long term. You don't want to be dealing with these companies because in the long run, they're looking to make more money out of the project than you are. So be careful. Ask other people that had experience with these companies. If a company approaches you, say, give me a list of 4 or 5 people that you have already worked with and closed out deals, not just ones they're working with now, but ones that have actually had deals that closed out, and talk to those people and ask them how happy are they having dealt with the company and what issues they ran into. All right?
That's great advice.
Okay. Other question?
Hi, James. Well, I have a question about F corporations that previously was used to hold properties, but has been inactive for several years, and considering changing over management, using that as a management corporation. Is the problem with doing that, or just to start a corporation?
Does the S corporation actually are they on title to the property or not?
Previously, it held subject to deals in it, but there's no properties in that corporation now.
Yeah, subject to deal should go into an LLC as well. If the S corporation that you have that's kind of been inactive for a few years, I assume you've not filed tax returns for those few years either, right? Or have you filed 0 returns? Okay, let's assume you file 0 returns for those years, and you don't have any liabilities that you're worried about from the S corporation's activities in the past. You can use that same S corporation now for managing property or doing flip properties. That's okay. Now, if the S corporation didn't have income and your accountant told you not to file any tax returns for those few years, you could have an issue there. IRS doesn't know that S corporation didn't have any income, and so they'll start knocking on your door, finding out what happened to those lost years. So if you decide to use that S corporation again, then you might want to have your accountant file 0 returns for those years that weren't filed for. However, I will tell you, if there's any liabilities that you're worried about from the past, just close that S corporation down and start a new one. In Georgia, it only costs $100 to set up a corporation, and filing with the IRS to get an S status is very simple to do. Just go to irs.gov and you'll find the form to do that. It's Form 2553, by the way.
Okay.
All right. Well, good luck on that.
Okay. Thank you very much.
Mm-hmm. Other questions?
This is Chris Ford again.
I'm sorry, I can't hear you. I know somebody's asking a question, but I can't understand.
Chris Ford, can you hear me?
Chris, can we get you to speak a little louder?
Can you hear me now?
Yes.
That's better.
Okay, sorry about that. So in today's market, what are the challenges from the investor standpoint? Are we still able to own a finance or do a lease purchase?
Okay, if you're doing lease purchase, if you're the buyer on a lease purchase, no problem. As a seller on a lease purchase, you could have an issue with a homeowner occupant, somebody's going to actually live in the property. The same is true if you sell and take back financing on a property. If the person is going to live in the property, those two situations both fall under the Dodd-Frank Act. So you could have an issue there as an individual. If it's in your name, you could do one of those a year, but you've got to also check and make sure that the people have the ability to pay. You don't have to document that as an individual selling, but if it's a trust or corporation or LLC selling the property, you do have to document the fact that they do have the ability to pay. And basically, the rule of thumb for ability to pay under Dodd-Frank says that their income or their debt-to-income ratio is no more than 43%. That means of their monthly income that comes in, no more than 43% goes to paying down on debt such as car payments, leasing that they got on household appliances, household goods. So you got to be careful about not going above that. You also cannot have a balloon. Now, you can have a balloon if it's in your name and you sell it and take back financing, but you cannot have a balloon if it's your corporation or LLC that's selling. The rules are onerous. I'm trying not to sell to homeowner occupants. I sell to other investors such that I don't have those rules affecting me. But you need to educate yourself on the Dodd-Frank Act and know it's brand new, so there's still a lot of questions. Going to have a bunch of court cases to decide exactly what the different provisions mean. There's a couple thousand pages of law there, and it's not something that's easily gone through. Plus, there are groups trying to get Congress to change some of those parts that affect individual investors. One group's out of Ohio, another one is in Washington, D.C., but because of midterm elections coming up in November, you're not going to see any action on it until at least next year, and then it's probably going to take another year before something happens. So I wish I could give you a brighter outlook for that, but right now it's cumbersome. All right, another question?
Hi, Dyches. This is Rashid. I've got two questions. One is I bought a property from an auction, courthouse auction, and I'm looking to flip it. So based on the market value, I'm probably going to be making about $20,000 to $25,000 on it. I did buy the property under my name. This was with a partner. So one question is, we're going to split the profit, but then there's going to be tax liability on it. So what can I do to kind of figure out how to split up the tax liability too? And then the second thing is, I know you mentioned hard money lending and wholesaling as alternates for auction properties. Any other avenues for buying good deals?
Okay. All right. First of all, is this the first house that you are flipping, Rashid? All right. Let's assume this is the first house that you're flipping, that you don't have a history of flipping. Then what you might want to do, and you talk to your tax preparer about this, is because that $20,000-$25,000 that you might make on it is not, you don't have a history of doing flips generating that kind of income. You can put that on as a short-term capital gain because you really haven't created a succession of business transactions. So once it becomes a succession of business transactions, the IRS says it needs to go on Schedule C, which makes that money subject to Social Security and Medicare taxes for self-employment tax, as well as ordinary income taxes. If you're able to put it as short-term capital gains on Schedule D, then there's no employment tax on that. So that'll help save you a little bit of money right there. Otherwise, you'll be able to offset any profits, obviously, with the purchase price and the expense. So make sure that you keep a good record of all your expenses that you can apply toward that. Now, you can't really use a 1031 exchange on it unless you held onto the property, put it into service, which means that you rented out the property for a period of time, and then you could sell it and avoid, or defer, I should say, not avoid, but defer the taxes into another property so you could use all of what you earned on the next property that you purchased. All right? Now, the second question, repeat that one again because I've already forgotten it. Remember, I'm getting to be old here.
Sorry. So one of the follow-ups to the first questions was that we bought the property under my name. So I'm assuming that when I sell this property, I'm going to report this as a capital gain on my 1040.
Yes, but only that first property that you sell like that. After that, it won't be a capital gain. It will be a business property, and you'll have to put it on Schedule C, and your tax preparer will help you with that. But yes, that first one, put it on the capital gain on your capital gain schedule. And another thing that's going to happen is when you sell that property, the attorney's going to fill out a 1099-S and he's going to want your Social Security number. So the IRS is expecting to see that property on your personal tax return, so make sure you put it there. Now, in the future, you might want to set up an S corporation and buy it in the S corporation and then sell it out. And the S corporation then will pay you a salary and it'll pay you a dividend. And only the portion that it pays you as a salary, and it might be a very small amount of salary, is subject to those employment taxes. So that's how you can control employment taxes with the flipper properties. Okay?
All right, thanks. And the second question was, I know you mentioned wholesaling and hard money lending besides auction properties, but based on my last couple of months of going to auctions, the auction properties are drying up. So any other avenues besides these three?
Okay. You're exactly right. Auctions properties are getting much tougher to find good deals at. The courthouse steps, as I said, really isn't a great place to go right now to find good deals. I'm not sure if you were asking about where to find the money or where to find the deals. Now, I answered the question about where to find the deals a little bit earlier, is knocking on doors and sending out mail-outs. That's the way that we're finding deals now, both for long-term hold and for flip. The question on the money, you're always going to have a hard time with a hard money lender going to an auction, and the problem is that you don't actually have a title at the time that the money is needed. And if you're doing a live auction that gives you 30 days to close, a lot of hard money lenders will work with you on that. But at the courthouse steps, you've got to have the money the day that the property is knocked off. And hard money lenders are very reluctant to give you money until they can get a security deed on the property. So your best bet for finding money to do auctions is going to be to find a partner that has the capital to do that, or some civilian lender that might not like the 1% they're getting in their CDs, and so they'll go with you to the auction and you buy the property. Sometimes they'll want to buy the property in their name. Now, that's not bad, because all you need to do is get an option on the property, get the fix-up done and sell, and then you get paid off based on what your option price was, and they get paid off based on the use of their capital in buying the property. That answer your question? All right?
Yes, thank you.
You're welcome. Good luck. All right, one thing I might mention while some of you are thinking of another question is, I was asked Monday night, how do you get on my free email newsletter? And if you got your pencil and paper right there, just send an email to Boddiford, Boddiford, that's again Boddiford, @gmail.com. And just put in the subject email newsletter, and put your in the body of the email, just put your name, the email address you want to use, and the town that you live in. And I will put you, or have my assistant put you, in our email database. I do not share that with anybody else, so you're not going to get spam. I'll send out an email usually once or twice a month. And so if you'd like to be on the email list, again, it's Boddiford @gmail.com. Include your name and your email that you want it sent to, and your city that and I'll assume if you're not in Georgia, tell me the state too, but I assume most of you are in Georgia. Another question. Okay.
Hi, this is Joe. I have two questions. The first one is for self-directed IRA. What are the appropriate real estate investments if long-term, buy and hold is not an option, it's not a good strategy?
Okay.
The second question is on the corporate structure for long-term buy and hold properties. And I attended your the general meeting, and you mentioned, you talk about building a wall between yourself and your properties. including the master corporation and the other, entity. So what would be the appropriate entity for the master corporation, and what would be the children?
All right, John. All right, first of all, you asked about self-directed IRAs. Now, I don't like property in a self-directed IRA because it loses all the tax benefits and it also brings all the liabilities into the IRA. Now, there's a longer answer than that, but that's basically why I don't like it in there. I like mortgages, I like options, but not properties, not flipper properties, because that's considered a business. You're not supposed to run a business in an IRA. And I don't like long-term hold properties either. If for some reason you absolutely had to put a long-term hold property in an IRA, then you would have the IRA hire an attorney. Now, this is not something you do yourself. You have the IRA hire an attorney to set up a self-directed, a IRA-owned LLC. Now, that has different paperwork. It has different operating agreement than a standard LLC. And the only member would be your IRA, and you would have a manager appointed that is not you, some third party, and not someone you do business with on a regular basis, and not some member of your family. So it needs to be a true third party as manager. Now, that's what you would do in your IRA. Now, outside of your IRA, if you're flipping property, and by the way, I'm going to say this, everybody's situation is different. And I'm sure you understand that. So you don't have the same structure for everyone, but I'm going to give you the structure that 85% of the people would use, and that would be an S corporation. It's got a liability shield. Have it for flipper properties and for managing properties. So any quick turn properties that you do, managing properties, say that you do a master lease with the right to sublease, do that through the corporation. Your long-term hold properties should be in an LLC. And Monday night I did talk about a master LLC that you and your spouse, say, owned, or it might be you and one of your children, or it could even be you with your S corporation as members. But it's an LLC, and the LLC owns, in turn, single-member LLCs that in turn own the real estate itself. That way, each house that's in a separate LLC, if there's a liability that occurs, it only affects what's in that single-member LLC. So if you've got just one house in there, it's not going to affect you, and it's not going to affect your other houses. Now, you might have 4 or 5 in that single-member LLC because, for instance, you might not owe but, say, you might not have but $2,000 or $3,000 worth of equity in 4 or 5. So the total equity for 5 properties with $3,000 in each property of equity is a total of $15,000. And so it would be a little cumbersome to try to put one of those properties into one LLC individually, so that you had 5 LLCs. So you might want to group them together. If you're just starting out, though, just start with single-member LLC owning the property and add the master LLC as you get several properties so that you can group them together. The multi-member master LLC we talked about is the only one that has to have a bank account. It's also the only one that has to file a tax return. The single-member LLCs are considered disregarded for tax purposes, so you don't have a tax return for those LLCs. But even though there's no tax return for those LLCs, each one has a liability shield for a liability that occurs inside of the LLC. In other words, the properties that the LLC owns. Then as you advance and understand all of this better and you have more and more properties, you might add to that the land trust. The land trust owns the property. The single-member LLC is the beneficiary of the land trust. The master LLC is the single member of the single-member LLCs, and you and your spouse, you and a child, or you and your corporation are the owners of the master LLC. Now, the reason you want that master LLC to be multi-owner is for 2 purposes. Number one is it has to file a tax return, but it's a very, very low-profile tax return. It's 1065 tax return. And so, therefore, you've lowered your audit profile with the IRS. You're not trying to scam the IRS. Don't do that. It's just that you won't have as many questions to ask about that you put on, 3 roofs this year. Why did it take so much? Those questions don't tend to come up in a very low-profile return. The second reason you want multiple members of the master LLC is something called the charging order. Let's say, for instance, you run into the attorney in the crosswalk, and the attorney, when he gets out of the hospital, decides to sue you for hitting him. Well, he might get a judgment against you personally. Well, anything you own is subject to that judgment. So the LLC, your interest in the LLC is subject to that judgment. But the attorney cannot go inside of the LLC and pull out a house and use it to pay for the judgment, because you've got another innocent third party, another member to that LLC, even if that other member to the LLC is an S corporation that you own. So that discourages a lot of litigation having to do with busting an LLC. That answer your question? All right, do we have another question?
And this is going to be our last question. So who wants to ask the question of the evening?
This is Amy. I would like to ask the question.
All right, Amy.
I'm the one that started. I've got like 4 rental houses. Didn't get around to putting them in LLCs yet. 2 have mortgages on them.
Okay.
What do I do
with that?
With the mortgages? Yes.
Okay. Go ahead and form the LLCs, and you're going to need to deed the property into the LLC. Now, before I answer about the mortgages, let me tell you, a lot of people say, well, my name is on the courthouse record showing that I owned it before the LLC. Well, that doesn't matter. If the liability occurs after the LLC takes title to the property, then they have to deal with the LLC. They can't come after you because you own the property before it went into the LLC. Now, if the liability happens today while you still own the property and you put it in an LLC a week from now, then the LLC is not going to protect you at all because you own the property the day the liability occurred. So I would say go ahead and get the LLC set up and deed the property into the LLC. And by the way, in Georgia, you can avoid the transfer tax if you check the box about you're capitalizing a company. And so you only end up with filing fees, which are usually less than $20 to put it into the LLC. Your second part of your question was, what about mortgages that you have on the house? Well, technically, you've transgressed the due on sale clause because you've transferred the property to someone other than yourself. And under state laws, an LLC or corporation, for that matter, is considered a separate person. But if you continue making out the checks, sending them in, keeping the taxes paid, keeping the insurance paid, I know of no one that's really had a bank or other institution question them about having transferred the property. However, let's say that you've got a real tough bank that doesn't like you transferring the property, and so they say you got to transfer it back. Well, you can transfer it back into your name and wait until they calm down and go away, and then you can transfer it back into the LLC. You can do that back and forth, and every time it should only cost you about $20 or so for the filing fees. We don't hear of that happening, but that is something to know that you can do. Now, the other question you didn't ask is, how do you deal with insurance? On insurance, you've got your name as the policyholder. You've got the bank's name as the mortgagee. Keep that insurance and have your insurance company add the name of the LLC as an additional insured or an also insured. Different companies call it different things, so that both you and the LLC are covered. The reason you want it done that way is, number one, that's the policy is already going to the mortgage company, so it shows your name on it, and also the fact that you're adding the LLC really doesn't matter. But if there is a claim, if it happens to be a liability claim because you were on the property when something happened and they sued you personally, you want the liability coverage to cover you. if the house burns or there's vandalism or some other covered claim to the structure or to the property structure itself, then you want the LLC named because the LLC is the one that actually owns the property. Also, by having your name remain on the insurance policy, if you have a personal umbrella, you can have the coverage extended from the dwelling policy, the $300,000 or $400,000 that's the limit on the dwelling policy, up to the $1 million, $1.5 million, $2 million, whatever you have for the personal umbrella policy. Okay, Amy? Thank you.
And for the tail end of your comment, Dykes, if I were to put a couple rental properties...
Okay, you're breaking up on me. Just try it again. Now, you got a couple of rental properties. What do you want to do?
If I put a couple properties in an LLC and then die one day, how would how would the property be transferred to my wife, or what would she have to do?
Okay. If you had a couple of properties, you put it into one or two LLCs, and you own the LLCs, what would happen when you passed? The properties would not change names at all. Nothing would change at the courthouse. As a part of your estate would be the ownership of the LLCs. And if your will said that the ownership of the LLCs went to your wife, then that would control, and your wife would be named as the member of those LLCs.
Okay, thank you.
All right, good.
Thank you, everybody. We want to now kind of mute out the call a little bit and have Dykes close us out, and he'll be able to share with everybody where you can get more questions answered. So, again, we want to thank you for being on this call tonight. You asked some great questions. You received some amazing answers, more than one answer. So, with that being said, Dykes, thank you again so much for being on this call tonight. How can people come out and get more information? Can you give us the time, the date, and where they can sign up?
Well, August 23rd and 24th, Saturday and Sunday, not this coming weekend, but the next weekend, I, along with Mary Hart, who is an estate planning attorney, will be doing a 2-day class on estate and legacy planning for the real estate investor. What we found over the years is a lot of people complain about going to get estate planning done, and first of all, the estate planner talks over their head and confuses them about what they can and can't do. Second of all, the estate planners in general, most estate planning attorneys, don't know how to deal with real estate as a part of an estate plan. So that's what we're doing this weekend, is discussing the things that you can do for estate planning, not only when you pass, but before you pass. How do you effectively retire? How do you deal with properties as you're in your what we call the ender stage, when you just want to kick back, take trips, and you don't want to have to deal with the property. So we'll talk about that. We'll talk about estate plan itself. Do you need a will? Do you need a living trust? We'll tell you the pros and cons of both. And as I said Monday night, wills, for instance, you definitely have to have a will if you have minor children, because the only way you can appoint someone as guardian for your minor children is through a will. You can't do that under any kind of trust. And we'll talk about the different kinds of trust. We'll talk about some of the tax planning trust and some of the things that will benefit real estate investors in general. The 2-day class will have a lot of out-of-state investors coming. We've already gotten 40-something signed up. A lot of them are from out of state, so networking will be great. You'll get to talk to people that you have a whole bunch of properties, and you can see how they built their portfolios, what they're doing with them, what's working for them now. And Mary and I both will be around during the whole seminar for you to ask one-on-one questions, even outside of class, if you have a particular situation that you want to discuss. Georgia RIA has a link on their main page, georgiaria.org, and that goes to this, and you can sign up there to come to the class. And we look forward to having as many of you as can come. because I think it's going to be, we've gotten real good response in years past when we've done this class, and we don't do it every year. So I would encourage you to look at this and sign up for it, no matter what age you are. Now, this is not only for you, about your estate, but about how do you deal with your parents and how do you deal with your children and how they can set up their estates as well to complement what you're doing. So it's intergenerational. So it's something that I think you'll find very beneficial over your investment career and building your portfolio. All right? So, Wendy, I appreciate the opportunity to do the Q&A tonight, and I encourage everybody to learn more about real estate and continue their investing.
Thank you so much. It's been a powerful hour plus minutes. We really appreciate you and what you've brought to the real estate industry, and we look forward to joining you at that event 2 weekends from now. Again, everybody, thank you. Thank you so much, Dyches. We appreciate it.
Thank you.
Have a good night, everybody. This call is officially over.